I guess the only question on everyone's mind is how to make the best of the rally that you're already seeing. If you're already fully invested in the market, what do you do then?
Now, if you're fully invested, just enjoy the ride because the markets are set to go even higher, apparently because of a lot of conducive developments that have happened, one of which you yourself alluded to in terms of the Fed action. If you're going to see Fed easing out in terms of the policy, there'll be a lot of money that will come to the shores of such countries as India. Not only that, within India, the grip of the manufacturing sector has been now quite good. There was a surprise GDP number, growth number within the manufacturing sector when we last saw the GDP reported for the quarter two. And that said, it tells you the story that with the capex that we have been seeing, the steady growth in capex, now the manufacturing GDP going up, we should see that cycle turn quite positive ahead. And with a lot of money coming in, valuations will still reach higher. Uh, and even at this juncture, given the corporate profitability growth ahead, the valuations don't seem challenging. So if you're fully invested, just ride the wave. Probably it's only the time to clean up the last three, four stocks that you have in your portfolio that don't perform.
What's the sense on FMCG, ITC, Nestle? We heard the commentary in terms of the channel checks which are done for HUL as well, and clearly rural is not picking up the way Street was anticipating.
Yes, you are right. The rural segment is still sputtering in terms of the demand growth there. And I believe that it will take some time for the rural sector to really grow. Part of it is also dependent on how inflation will get tamed ahead. The rural segment is quite sensitive to the inflation dynamics. So higher inflation would mean that the consumption rapidly drops. And we have also been hearing a lot about this commentary related to the K-shaped recovery. That means a lot of premiumization that is happening with the top end of the market actually growing much faster and making up for the fall in growth in the lower end of the market. That said, that clearly affects the mass consuming kind of products that some of these companies in the FMCG sector produce and deliver. Lever also has some mass appeal products. So does Nestle. While they have categories for the premium segment, for them the mass segment is what really drives the volume growth and drives the overall growth in the top line. Sometimes that is essential for these companies to get better valuations or better valuation outlook from various investors. So FMCG will probably continue to face trouble given inflation is not yet tamed, but on the way to be tamed. IT sector, the earnings growth is very lackadaisical, and we have talked about how recruitment in IT has stalled. In fact, the headcount has also come down. There are margin pressures coming in. But the important factor is that in all this story of gloom, the IT sector did have one positive in terms of deal wins that they were getting it. The deal starts were getting delayed. The deal wins were there. And I think it's time for those deals to start happening because now that the Fed has talked about reducing interest rates and the US economy has actually shrugged off the fears of recession. That tells you a lot of confidence will come back into IT spending, led by the US economy, of course, and our companies here will be therefore be able to deliver the slow growth. The deals starts will start happening now, and they will start doing better. I think some of it is already getting factored in the way the IT stocks have moved. Year to date, yeah, till 2 days ago, the year to date growth in Nifty IT was 15.5. Today it is 24%. Suddenly it's 10%, 9% kind of jump in 2 days.
Right. Okay, that's
It's been getting too euphoric right now. A bit of a vertigo for the bulls or not yet?
No, I don't think so, because purely from a valuation perspective, I think we haven't reached the peak. Maybe we have reached the peak in terms of the market, but from a valuation, the peak is still some time away. And plus, we have gonna have major tailwinds coming in with the COVID kind of legacy gone, with all the capex related issues now resolved, all these tailwinds and inflation on the mend, all these tailwinds would mean corporate earnings will start surging ahead, and we will have therefore better valuations to look forward to pick into the market. One could become stock specific, but I don't think the overall market is gonna give up gains so quickly.
No, it's not getting too meteoric right now, at least for the bulls and the valuations, but
No, it's getting
20,500.
meteoric. They're not getting vertigo.
Okay, so it's getting meteoric but not getting vertigo. That's the verdict coming in from Aisha. Let's see.
No, that was your question, so I'm just correcting you.
Fair enough. But in the meantime, let's take a look at which were the big buzzers for the week gone by. You had IRFC, which is higher by 24%. Hoodco has had a good run, 20% higher. Mastech was one of those IT stocks that has managed to clock in gains of around 16%. Chalet, JM Financial, Steel Authority, Nalco, NLC, these are some of your other big gainers, but it's not all been okay. Industries, that was a key laggard this week, 12% cut. Manyavar is the other one. Actually, we didn't realize it, but that stock is down 9% in this week itself. Torrent Power 2 is coming under pressure, and Paytm and Delivery too. In fact, Mahantesh, we have stopped talking about some of these new age tech companies, right? Paytm, Delivery, Zomato, Honasa for that matter. What's the latest recommendation and view on these?
So some of these new age tech companies have run their course. I think the basic problem with many of these companies when they listed in the market was they commanded too high a premium or demanded too high a premium in terms of valuations without having an underlying confidence in growth. But at least the part on the growth, that is the part of the growth has been taken care of. Some of these companies have returned back to profitability, good amount of business changes driving profitability ahead, and overall revenue growth now seems to be more secure. But they still have to shrug off that premium or excess valuations yet, and you still have a lot of overhang in terms of earlier investors wanting to sort of book their profits and get away. So there will be pressure on some of these stocks going ahead. I would be a little choosy, or rather avoid this sector when given the fact that old age economy stocks, some of them are really doing very well. Take SBI for example, the classic old age economy stock, which is a bet on India as a whole, is doing really well. So one should be picking those stocks, then worry about what's happening with some of these new age tech companies. Let them fight their battles in terms of revenue growth, profitability growth. Once they are in the good valuation zone, one can once revisit them and take a look.